Right, welcome to our lecture on the Conceptual Framework of 2018. You need to know that the Conceptual Framework is not an accounting standard. This is principles provided to consider when they set accounting standards. Now, in a scenario, when you receive a detailed scenario and you need to discuss, is this an asset or liability? Guys, where do you start? First, you need to start with your IFRS standards. Now, normally in the IFRS standards, such as PPE, they will indicate to you that it has to meet the definition of your conceptual framework. Then, yes, you need to touch on your definitions of your conceptual framework. But let's say, for an example, that there is no standard available. Then you need to refer to your conceptual framework. Therefore, if I ask the following question, which will prevail, your conceptual framework or your standards? Your standards. If there's no standard, you need to refer to your conceptual framework. The scope of the conceptual framework, what will we discuss? Our conceptual framework is divided into, I'm going to call this chapters, into 8 chapters. It includes the objective of the general purpose financial reporting statements. Now, guys, they make reference to general purpose financial reporting, general financial reporting. Right. Second chapter relates to the qualitative characteristics of useful financial information. Third chapter relates to financial statements and the reporting entity. We are going to spend quite a lot of time on chapter 4, elements of financial statements, which is always important. This is where we need to discuss, is this an asset, liability, income, or expense? And we need to look at the recognition, and now they talk about derecognition in the new conceptual framework, which we need to apply in terms of our elements. We will look at measurement briefly, and then briefly touch on a bit of presentation and disclosure, briefly touch on the concepts of capital and capital maintenance. The objective of general purpose financial statements, guys, IFRS framework describes basic concepts that support the preparation and presentation of financial statements that is useful to a wide range of users in making economic decisions. Right. Now, let's apply this to a very basic example. I want to buy shares in JSE listed entities. Right. Now, I need to make decisions on which entity I want to buy in, why. Okay. Now, the IFRS framework or our IFRS framework is there to assist us in terms of the preparation and presentation of these financial statements. Guys, if this is prepared in terms of IFRS, I know that I'm comparing certain rules in terms of the different entities with each other to make an informed decision in which entity I want to invest in. Right, now, on what will be reported in the financial statements? In the conceptual framework, they make reference to economic resources. Economic resources meaning assets which have the ability to generate economic benefits, and claims against the entity. Now, guys, claims, this will be your liabilities, possible liabilities. The financial statements will report on any possible changes in terms of our economic resources and claims. Our financial performance will be reflected by an accrual accounting. Now, guys, you know accrual accounting, this will be, we recognize as and when the transaction occurs. Therefore, accrual accounting does not take into account the cash flow. Financial performance can be reflected by past cash flows. Now, when we look at past cash flows, pretty interesting, guys. Cash flow helps users to assess the entity's ability to generate future cash inflows and outflows. Therefore, this is a tool to assist them to determine solvency, liquidity ratios, and to understand those ratios when you focus on the cash flow of the entity. Okay, guys, just a quick one. Who prepares the financial statements? Management. And this is very important that you need to know this. I'm pretty sure you did do this in auditing. Management has to prepare the financial statements. The auditors cannot prepare the financial statements. Please remember that. Right. Now, when you look at the conceptual framework, they make use of management stewardship and discharge. I've included these definitions for you. Right. When you think about our objective, you will remember that we have identified that our financial information has to be useful. Therefore, the focus is on useful financial information. Okay, so when will our information be useful financial information in terms of the conceptual framework? The conceptual framework indicates to us that it must be relevant, therefore it has to have relevance, and it must be faithfully presented. And then this information will be enhanced. And this is where our enhancing qualitative characteristics comes in. It will be enhanced, supported by comparability, verifiability, timeliness, and understandability. Therefore, the fundamental qualitative characteristics of our financial information will be relevance and faithful presentation. The enhancing qualitative characteristics, remember, enhancing, it supports the fundamental qualitative characteristics, will be our comparability, verifiability, timeliness, and understandability. Now, let's briefly look at each of these separately. When will information be relevant, or when will the information have relevance? The information must be capable of making a difference in the decisions of the users. If that information is capable of making a difference in terms of the decisions of our users, this will then be relevant. Right. And when we look at relevant financial information, the conceptual framework indicates to us that this can be when there is predictive value, or this can be when there is confirmative or confirmatory, or both. Therefore, this is or both plus. Right. Now, when we look at predictive value, what is predictive value? This is information to be used to predict the future. Think about this. Predictive value to predict the future. Confirmative value is information about previous evaluations. Therefore, this is, and I'm going to call this feedback, guys. Sorry, let me just correct the spelling here. We call this feedback on history. Guys, this does make sense. When you look at financial statements, it will be relevant in terms of useful to be able to make decisions. If I can, yes guys, and I know we do not have a crystal ball, but you can see some kind of things in the financials in terms of cash flows. If we are able to predict future scenarios, outcomes, and if we are able to confirm what happened in history. Right. Now, when we look at materiality, what is materiality in terms of our conceptual framework? Information can be material, and this is an important thing to ensure that you understand. If you do not include that information, guys, if you do not include the information, this will have an influence on the decision makers, the people that actually use the financial statements. Or if you misstate this, if you misstate the information, this is also material if it has an influence. Now guys, when we talk about influence on the users, material versus immaterial, I know you do cover this in terms of your auditing, but just think about this briefly, guys. If you look at a set of financial statements and they did not include, let's say for example, a liability of 100 Rand, in the bigger picture, what is that scenario or the percentage of that liability in the big picture versus assets, liability, equity? Guys, not really that material if it's a big entity. Therefore, guys, you need to try and understand the specific scenario. Will that amount, if it's not included or if it's misstated, will it influence the user's decisions? And that is the important thing that you need to ensure that you understand. Right, now let's move on to our faithful presentation. It has to faithfully present all information, one, as complete as possible, plus the information has to be neutral. Now guys, you can refer to the Conceptual Framework. This is included in 2.16. The information should be supported by prudence, not over or understated. And it has to be free from errors. Now, let's be honest, guys. It cannot always be 100% accurate. You need to use the best framework, the best estimate, the best calculation. But important, it has to be documented. There has to be supporting evidence for decisions being made. Right. Now, this is our fundamental qualitative characteristics. Remember, this will be enhanced, this will be enhanced, supported by our enhancing qualitative characteristics. And this is pretty self-explanatory, guys. The information provided in the financial statements should be comparability. It has to be, we should be able to compare the information in terms of different sources. Right. Then verifiability, there has to be sufficient details to verify the information that it is faithfully presented and ensure that it is relevant. When we look at timeliness, it should be in time to influence the decisions, and it should be understandable, classifying, characterizing, and presenting the information clearly and concisely. And guys, always an important thing to just briefly mention that there is some kind of cost constraint involved to be able to apply on all of these different qualitative characteristics. The third chapter in our conceptual framework relates to our financial statements and the reporting entity. Guys, always try to think about the objective. Remember, the objective is to provide useful financial information to be able to assist users in making decisions. Right, now you know that our financial statements will consist out of our assets, liabilities, equity, income, expenses, other statements, which is pretty important to me, our cash flow statement. Okay, guys, very important, and you need to know this. And guys, this is normally included in discussion or basic discussion questions that we tend to miss, is that our assets minus liability equals equity. Right, you know that. Okay, reporting entity. Remember, this can be a single entity, one entity. This can be a portion of an entity. You can prepare financial statements for that portion, a branch, or this can be more than one entity, and this will be our consolidated financials. Then important to remember, guys, financial statements normally prepared based on a going concern. If it's not a going concern, we cannot use our going concern principles. Right. Now, let's move on. Elements of financial statements. We're going to spend quite a lot of time on this. I'm pretty sure you know by now that your statement of financial position consists out of your assets, liability, and equity. And you know that your assets minus liability equals your equity. Don't miss this in a discussion question, please. Our statement of financial performance consists out of our income and our expenses. Right. Let's have a look at our definition of an asset and liability closely. You need to bear with me. I am going to read through the definition with you, and then I am going to explain it to you. Now, when you look at your screen, first, what is important to identify in terms of your assets and liabilities as is that you need to first be able to discuss the definition of an asset or liability. Conclude that yes, this is an asset or liability, or no. If you have concluded that yes, this is an asset, you may only recognize that asset once you meet the recognition criteria. Only once you meet the recognition criteria, you may recognize that asset or liability. Therefore, yes, it can be an asset or liability in terms of the definition. But if it does not meet the recognition criteria, you do not recognize that asset or liability. Then another important thing to identify, guys, is that your recognition criteria will be discussed in Chapter 5 of your conceptual framework. The elements is included in Chapter 4. Now, when we look at the definition of an asset, the conceptual framework indicates to us that this is a present economic resource controlled by the entity as a result of past events. But what is the economic resource? This is a right, and important, guys, to focus on the right that has the potential to produce economic benefits, guys. Therefore, when I think about this, it is a right, it is something that has the potential to provide money. This is in my mind, money, income. And this is our economic benefits. Identify the difference. We are talking here about economic resource and economic benefits. Now, to be able to identify this as an asset, we will have to identify, one, is there rights involved? Plus, is there the potential to produce economic benefits? Plus, is there control? If your answer is yes, this is an asset, but we may only recognize the asset if this is relevant, it has relevance, and it can be faithfully presented. Now, guys, when you look at this, relevance, faithfully presented, does it ring a bell? Yes, this is your fundamental qualitative characteristics. Remember, we did discuss this. This is your fundamental qualitative characteristics. Now, look at the liability. The definition of a liability. It is a present obligation of the entity to transfer economic resources. Do you see, guys? Economic resources, not economic benefits. Remember, previous conceptual framework, we would talk about future economic benefits. It is a present obligation to transfer economic resources as a result of past events. Therefore, we will have to discuss, one, is there an obligation? Plus, that obligation, does it have to transfer economic resources? Plus, does it exist due to a past event? If your answer is yes, this is a liability, but we may only recognize the liability if we meet our recognition criteria. Okay, guys, bear with me. I am going to explain this to you step by step. This is a pretty nice table. It is included in your conceptual framework. Please read through this. What I want to highlight to you is the income. This is increases in assets or decreases in liabilities that results in increase in equity other than those relating to contributions from holders. Expenses, decreases in assets or increases in liabilities that result in a decrease in equity. Therefore, guys, the important thing, assets minus liabilities equal equity, right? Okay, now let's have a look at our recognition and derecognition. Remember, I am going to explain to you the definition of assets and liabilities in detail. I just want us to look at this as a combined scenario in terms of definition and recognition. Right. Now, when we look at the recognition, we may recognize the asset or liability if it meets one, our definition of the asset or liability. Remember, it first has to meet the definition. Then we need to move on to number 2, our recognition criteria. It has to be relevant and faithfully presented in terms of our fundamental qualitative characteristics. Now, we will look at the existence in terms of uncertainty, if that is an asset or liability. This is where this comes in, guys. The existence in terms of uncertainty, if it is an asset or liability. And then, when there is a low probability in terms of in or outflows of our economic benefits, not the economic resources, the economic benefits. Now remember, if there is a scenario in terms of our asset or our liability, remember we are now discussing assets and liability definition. Yes, we do think so, but there might be an uncertainty. I'm not really sure if this is an asset. Right. If this exists, guys, this does not mean that it lacks relevance. If we recognize our asset or liability, this does not mean that it lacks relevance. We always just have to ensure that we provide sufficient, accurate details in terms of the scenarios. Okay. Now, when we look at our faithful presentation, faithful relates to our amounts here, guys. Therefore, there might be measurement uncertainties, and this can influence the faithfulness of our financial statements. Right. If we are able to conclude that it meets the recognition criteria, we may recognize our asset or liability. We de-recognize our assets and liabilities, 1, in terms of our assets, when control is lost, and 2, our liabilities, when there's no longer a performance obligation to transfer our economic benefits.